Welcome back, ladies and gentlemen, for what is going to be nothing short of another jam-packed daily cryptocurrency market update. And we are coming to you live from my fireplace. I am at home today, but we wanted to release a daily market update as per usual. And we are really going to be talking about one topic and one topic alone in this video. And that is the macro reason to why we are bullish on not just the cryptocurrency market, but the sort of what you would call risk on asset class market as a whole. And it has everything to do with global liquidity and, of course, the dollar, which is a major driver of global liquidity. And what a week it has been for the cryptocurrency space. Obviously, on Monday, we saw the unwinding of the Japanese yen carry trade. And the idea there is that the Bank of Japan essentially became a financer for the world at 0% interest rates, because when you have 0% interest rates on a currency, it means you can borrow it freely and essentially take it elsewhere. The idea of carry trade, carrying it over to other parts of the world or other forex pairs, currencies, and then actually take that and put it into various stock markets. And we've always said the Nikkei is a short yen trade. It's a bet against the yen. And obviously we had, I think, the worst day for the Nikkei ever in history on Monday. And we had contagion with other markets as there was the kind of unwinding, the taking back, as we see the Japanese yen strengthen, of that carry trade. And actually, okay, I'm not necessarily happy in many regards that it happened in the manner that it did. Certainly our altcoin market got absolutely smashed. But in some senses, I'm happy that it happened because it's a real kind of educational event in regards to the ramifications of interest rates rising and the strengthening of a currency and what that means for assets. And if we look at what the United States is about to start doing and other countries in the world, they're essentially doing the opposite of what we saw the Bank of Japan doing for the first time in 30 years, first time in my lifetime. And we should see the opposite effect. So as they lower interest rates, it makes money and capital easier to access, which should find its way into the markets. On top of that, you also have right now a record, I think it's $6.4 trillion in money market funds. A lot of people sat in cash, of course, or various sort of cash instruments, essentially collecting that very high yield that, of course, on the back end of interest rates. As they start to lower those interest rates down, we're seeing 2-year yields collapse in the United States. You are going to see that money start to hunt for an alternative, yield, essentially. So there's a great fundamental reason to be bullish on the markets there. But this video is largely going to be talking about liquidity, global liquidity, why it's important, where the global liquidity index is at. It's in this kind of upticking stage. And we'll look at the driver of that, which I think we can get from the Dixie and the strength of the dollar. When they start to lower interest rates again, you're going to see cash flow freely and liquidity start to uptick as people start to essentially take money at a lower interest rate. And when the Fed starts to lower, if you look at historic easing cycles, whenever the Fed have lowered interest rates, they've typically not done it in a what's the right word here? Slow, snail pace. They've often done it at a very accelerated pace. And I think we're going to see a similar thing around this Fed easing cycle. There is a comment out there that's worth me just addressing in regards to, okay, well, every time the Fed pivot, the markets crash. This is an idiosyncrasy. Somebody said it somewhere, and now everybody repeats it. It's not the case. If you look at the past 5 times the Fed have actually eased, started to lower interest rates, only 2 of those times being 2000s and 2008, so the dot-com crash, when it was already crashing when they started to ease, and 2008, which was on the back end of course, the securities market around housing and the over-leveraging of it. They were really the only 2 times out of the past 5 times. Every other time the market's actually gone on and done well. And we're expecting a similar thing today. So that's what this entire video is going to be about. Let's just show you the importance, certainly in regards to crypto, of global liquidity. So this is from Cross Border Capital. A great guy to follow, by the way. Somebody who's, I think, certainly I've only heard of him over the past couple of years or so, but I'm sure he's been around for a lot longer. This is Bitcoin with global liquidity. And global liquidity, what is global liquidity? Well, it's things like M2, it's things like the Fed balance sheet, it's things like the Treasury issuance. It's kind of there's multiple things that go into it, but one major driver of liquidity and the kind of free-flowing nature of it is, of course, the Dixie and the strength of the dollar. So we've seen the Japanese yen strengthen and markets readjust as a result of it. And just like we saw the Dixie strengthen, markets went down on the back end of this, then they bottomed when the Dixie started to top. And now we believe the Dixie is coming down. This is ultimately going to align with what we're looking at in regards to global liquidity cycles, which we'll throw on the screen. Things like PMI cycles, things like the Bitcoin 4-year cycle theory. We'll explain it all in this video. So this is obviously the Bitcoin 4-year cycle theory, and this is PMIs, which we're going to be getting into. So you can see the importance of global liquidity. Certainly in regards to an asset like Bitcoin, it's probably hypersensitive to the macro situation. Again, Monday was a great educational kind of day, I think, certainly for myself, who's never had to contend with the Bank of Japan upping interest rates in my lifetime, because we got to see a hyper-exaggeration of the effect of interest rates strengthening a currency and the ramifications that has on risk. We're about to see the opposite of that for far potentially larger markets. Now, Japan is and I'm talking about the US specifically, Japan is the third largest economy in the world. It's a very large market. They are essentially a creditor to the world or a financer to the world, certainly with their 0% interest rate. So global liquidity, extremely important. It's our opinion, based on the global liquidity index, which I'm now going to throw on the screen, that we are looking at an uptick for global liquidity. And I think the driver of that is going to be the Fed lowering interest rates, the Dixie coming down, and the adverse of what we saw for the BOJ and the yen in regards to the Dixie. Again, great example. When they strengthened the yen, markets readjusted. They had to reallocate because capital became more expensive. Capital is now about to become a lot cheaper in regards to them lowering interest rates, and the ramifications of a weaker Dixie, a weaker dollar, should be that markets do well. And this is our great macro reasoning. And then we can, of course, dive into the technicals of Bitcoin, crypto, look at the direction that they're pointing us in. We've got things like Amazon and Tesla. Lots of smaller cap stocks are in what we would call phase 2, which is they've just sort of broken out of phase 1. They're just sort of starting their uptrend. Something like the IWM, even though it's seen massive outflows in regards to their ETFs, obviously in the last week, still think going to do very well. And many others out there. We're with Stan Druckenmiller in regards to his positioning. So global liquidity cycles looking to uptick. Liquidity is very important. If we look at things like PMI cycles, this is essentially a barometer for the economy. You can see just how close Bitcoin, sort of follows this uptick, downtick, uptick, downtick in terms of cycles. And markets are very cyclical. They do typically move in cycles. The Wall Street cheat sheet, whether that's Wyckoff's market cycles, Dow theory, Stan Weinstein's sort of stage analysis, they are very cyclical and impacted by multiple factors. But PMIs should be upticking. I do think we did have a pretty negative PMI report, but I still think this is bottoming and likely going to see upside. And then, of course, you've got the BLX, which is the Brave New Liquid Coin Index, which is the Bitcoin 4-year cycle theory, essentially. The best days are ahead of us, and this is what this video is all about, showing you why that is from a macro perspective in regards to liquidity, and one of the main drivers of liquidity, which, of course, is the dollar, which we're looking at here. So you can see very quickly, for those of you that aren't subscribed to the channel, for those of you that are, you'll be sick and tired of me talking about this. I wanted to make this a very macro one because we need that big picture. We've seen, again, Monday was a great example of just how tethered the cryptocurrency space is to the macro markets. We can't escape it, guys. We are the plankton at the bottom of the food chain in regards to markets. We're going to grow infinitely. We'll become a shark. We'll become a whale. We'll become the very thing that financial markets run on. But for now, we have to roll with the punches that are thrown our way. So you can see, obviously, these are the events of March 2020. Then the printathon, dollar very weak, markets up. And then with inflation, expectations, speculation that the dollar was about to start gaining some strength, they then dollar started to gain strength, and then they started to implement interest rates, which, of course, is one of the main drivers, just like with the yen, of interest rates. You can see the dollar had already started upticking when they actually upped interest rates. But this is also because markets are forward-looking. This is why I believe you've seen, when the dollar's gone sideways here, markets continue upwards because they ultimately know what the next move for the Dixie is. And we're going to talk about the next move. We've got technical patterns on the Dixie. We've got the potential for the Japanese yen to have bottomed against the dollar and now start to be in an uptrend. This is signaled by a bullish divergence here on the weekly. Also, a falling wedgie broken out of, potentially setting up a head and shoulders, inverse head and shoulders that could take you to the upside. This is yen versus Dixie. Euro USD, Euro looking for upside, and GBP looking for upside. And the Dixie is essentially the US dollar versus other currencies. Now, weak dollar, big driver of liquidity for risk assets. And you can see this is the correlation here. So as they started to up interest rates or certainly speculate and then actually implement them, markets adjusted. As the dollar topped, this you could certainly say is on the back end of interest rates starting to sort of slow down, a ceiling being met for them, and then certainly going sideways. And now the dollar, it's sort of taken its first little step towards the downside. And of course, you can look at things like, let's do it, yields, which are a predictor for interest rates and thus the dollar, to essentially drive what direction the dollar's going in. So where are we? Yield curve, 2-year yields, what we want. Yes. So this is well and truly a breakdown for yields. I don't think the Fed are going to be as quick to lower interest rates as people suspect. I think largely the market events had everything to do with the yen carry trade and not, if anything, it's kind of spurred them to keep the interest rates where they are because they don't want that collapse against the Dixie too aggressively. And they certainly know that I personally believe the economy is in a good standing and is actually going to get inflated with all the sort of, along with assets, which is why they're looking the way they do, along with the kind of better liquidity situation. The driver of that is going to be the Dixie. So we know the correlation here. One fundamental thing that, of course, drives the dollar is just like what drove the yen is interest rates. And you can see this has historically been true. Not only do we have this sort of channel that we've been in since 2008, and we think you're going to very logically make your way to the lower bound of it, we also did fall out the bottom of this grind line. Very much a triggering event, in my opinion. On top of that, you had, or are very close to, you certainly triggered the Great British Pound in regards to an upside move against the dollar, and we're on the cusp of a euro move against the dollar. And of course, the Japanese yen. More so the euro and the Great British Pound. When the Fed start to lower interest rates, their currency is going to lose ground faster than others that are perhaps doing it to even more or the same degree. And that's because the debt markets are simply larger for the Dixie. When you think about the dollar and the Dixie, it's against other currencies, but we can use it to look at assets. A strong dollar is typically not good for anything. Just like a weak dollar typically is going to see markets do well. And this is the main macro reason why we're bullish. And we've got confirmation that this is now the direction that we're going to be moving in. Certainly to sort of compound all this, talking about being bearish on yields, we've been one of the few people to be bullish on TLT, whilst everyone else has been saying to short it. We knew that because you had a bullish divergence on the weekly here. Also, you've now broken out of this, and I think this is very much basing and looking for an upside. We know yields are coming down. We know rates are coming down. We've got that whole story. Look at the volume here, guys. So we are essentially looking at a weak Dixie. This is signaled in regards to where interest rates are going, certainly in regards to where 2-year yields and 10-year yields are going. We also have technical patterns for this, whether it be the pattern that the Dixie's in, whether it be the correlation with oil and how we're seeing oil break down, whether it be the Japanese yen looking likely to wanting to have based. You can see again real bullish divergence here, potential structure setting up here for upside continuation. Euro, USD, and GBP, and the ramifications should be that risk assets do very well. This is why we've been calling for a 2,500 gold price, and we're very much getting towards that. And let's show you this as we're talking about it, because the charts really do help. And this is why we're technical analysts, because ultimately the charts give us, they can help us paint a picture that you just simply couldn't see if you were just speculating on news flows and even things like earnings and things. I truly believe that through being a technical analyst, you can spot the footprints in the sand. So we've been very bullish on gold since down here, making its way towards that 2,600 target, and then likely going to go higher. And we're looking at the likes of Tesla very closely. Obviously, Amazon marching towards our $261 target. Bit of a pullback recently, but it will resume. And then, of course, we've got all these sort of patterns for Bitcoin that we're looking at. Total 2, I still think, is very much intact, albeit an aggressive downside, and everything else. And when I look at small stocks, I don't usually do this with you guys, but they all look to be in the same direction. So I've had some cracking stocks in regards to things like Coinbase. A lot of my patrons buying this in the $30, $40 range. Many others out there. Robinhood was a recent one of ours. This actually made our target from the range. Something like Spotify, up, and away. We like to teach phase analysis. It's only available for the patrons. This was a breakdown. You can see lots of stocks in the very similar position in regards to they've now broken out their base and they're looking to go in an uptrend. These are small stocks. We can show you loads. Vanex Semiconductors, one that we did very well on. HubSpot, looking good. There's lots. I don't want to show you all of the hundreds, well, not hundreds, tens of stocks that we have that all look to be uptrending or about to enter an uptrend, along with crypto generally. And we know we've just looked at what the macro driver of that is going to be. It's going to be global liquidity, which is largely going to be driven by the Dixie. So we have put forward our macro reason for why we're bullish on the markets. We've been on the right side of the markets, certainly thus far. We got back into the markets back in 2023. We got out for the majority of 2022, back in for literally the perfect bottom for Bitcoin, perfect bottom for many altcoins, although they've had a lot rougher ride than markets generally. But their time is coming. So hang in there, guys. We're potentially looking at a pretty epic time ahead of us, and it's all going to center and crater around interest rates, the Dixie, and global liquidity. And I think crypto is going to be the best beneficiary of all of that. So that's it from me, ladies and gentlemen. I do apologize for not being in the office. Sometimes we like to take a bit of a day off. However, I still wanted to get an update out there, so we've done it from my fireplace. On that note, I'm going to love and leave you guys. Thanks a lot for watching. I'll see you all in the next one.